Hey, what's up everyone? Welcome back to the channel. Today we're diving into something that just dropped and could seriously fatten your crypto wallet. The 2025 crypto tax rule has been repealed. That's right, the rule that had crypto traders pulling their hair out. Gone. If you've bought, sold, swapped, or staked crypto in the last couple of years, this change could mean thousands back in your pocket. So what exactly got repealed? Who benefits? And how much could you realistically save? Let's break it all down. Straight, simple, no BS. What was the wash sale rule and why it sucked? Let's break down what just got repealed. The wash sale rule originally comes from the stock market. It says you can't sell an asset at a loss for tax purposes and then buy it right back within 30 days. If you do, that loss doesn't count toward reducing your taxes. It was meant to stop investors from gaming the system. But here's the thing, crypto isn't a stock, and for years it wasn't subject to that rule. That changed when lawmakers decided to apply the wash sale restriction to digital assets in 2022. The IRS started cracking down in 2023, and a lot of people got burned, especially short-term traders. If you were rotating between coins or trying to offset losses during a bear market, you might have ended up with a nasty surprise when tax season hit. The 2025 repeal of this rule means traders can once again use those losses to their advantage. Broker reporting was about to get real messy. The second part of the repeal involves crypto brokers and exchanges. Think Coinbase, Kraken, Binance US. A new rule was supposed to kick in requiring these platforms to report your crypto transactions directly to the IRS, the same way stockbrokers issue 1099s for stock trades. This was set to start in full swing in 2025. The goal was transparency, but the rollout was chaotic. Platforms were confused, the rules were vague, and users were worried about errors and over-reporting. With the repeal, this requirement is now on pause until 2027. That gives the crypto industry time to figure out reporting logistics and gives you more time to manage your taxes without unexpected 1099s triggering audits. What tax loss harvesting means in plain English. Now let's talk about tax loss harvesting, because this is where the savings really come in. Imagine you bought Ethereum at $4,000 and it's now trading at $2,500. Under the old rule, you couldn't sell it at a loss and buy it back the next day. If you did, the IRS would disallow the loss. Now, thanks to the repeal, you can. You can sell to realize a loss, rebuy the token, and still claim that loss against your capital gains. That loss reduces the amount of money the IRS considers taxable. And if your losses outweigh your gains, you can apply up to $3,000 of that loss to regular income. That's not a loophole, that's strategy. Used wisely, it can save average traders thousands and high-volume traders even more. Real scenarios. How much can you save? Let's break down some examples so you can see how this actually impacts your taxes. Say you made $12,000 in profits from trading this year, but you also have $9,000 in losses from altcoins that dropped like a rock. Without the wash sale repeal, you may have lost the ability to count those losses if you repurchased the coins too quickly. But now you can claim the full $9,000 in losses, reducing your taxable crypto income to just $3,000. If you're in the 24% tax bracket, that's over $2,000 in savings. Now multiply that across more trades, or consider someone with $50,000 in gains and $30,000 in losses. The savings could top $7,000. And that's without even talking about applying leftover losses to next year. This repeal puts real money back into people's hands. Privacy, simplicity, and less stress for now. Let's be honest, crypto taxes are complicated. Wallet-to-wallet transfers, staking rewards, airdrops, and swaps can be confusing even for experienced traders. The broker reporting delay gives you a little more breathing room. You're still responsible for tracking your activity and reporting it correctly, but now you're not up against automated IRS forms that could flag you just for a typo. It also helps if you use decentralized exchanges or non-custodial wallets, where there's no broker to send a form anyway. But don't mistake this for a free-for-all. The IRS is still watching. The difference is, you now have more control over how you file and how you explain your positions. What this means for DeFi, NFTs, and staking. While this repeal is a win for traders, it doesn't clarify everything. If you're earning staking rewards, trading NFTs, or using DeFi platforms, you're still in a gray zone. The IRS hasn't issued clear, consistent guidance on how these should be taxed. Are staking rewards income or capital gains? It depends on who you ask, and that's a problem. The good news: with the broker reporting delay, there's less risk of incorrect data being sent on your behalf, but you still need to treat DeFi and NFT income seriously. Keep good records, know the basics of tax treatment, and consider talking to a crypto-savvy accountant before tax season hits. Mistakes to avoid, even with the repeal. Here's the catch: a lot of people are going to take this repeal as a sign to go dark. That's a mistake. Just because the IRS isn't forcing brokers to rat you out yet doesn't mean they won't audit. You still have to report all gains and losses, and if you don't, the penalties can be brutal. The washed sale repeal gives you an opportunity to optimize your taxes, not avoid them. Another mistake: assuming the rules will stay this way. Tax law is a moving target, especially when it comes to crypto. What's allowed this year could be banned next year, so don't build your whole tax strategy on a temporary win. Use it, but don't depend on it lasting forever. What to do right now? So what's your move? First, go back and review your 2024 trades. If you had losses you thought couldn't count because of wash sale rules, you might be able to update that for 2025. Second, start planning this year's tax loss harvesting now. Don't wait until December when it's a scramble. Third, use a crypto tax tracker like CoinTracker, Coinly, or TokenTax to keep clean records of every transaction. And finally, if your trades are more than just casual DCA moves, talk to a CPA who understands digital assets. Don't rely on guesswork. This is about keeping more of your money. To wrap it up, the 2025 repeal of the wash sale rule and delay of broker reporting are a win for crypto users, no question. It means you can be more strategic, less reactive, and more in control of how your trades impact your taxes. But it's a temporary window. Congress could flip the switch again. Regulations are still developing. So be smart, stay informed, and take advantage while it lasts. If this helped you, share it with your crypto group or on socials. Help someone else keep their profits too. Thanks for watching. Hit that like, subscribe if you're new, and I'll see you in the next one. Stay sharp out there.